I know you've got some data on this. You've actually written a little bit about this. But before we get into your data, I wanted to go through a few companies and just hear, like, do you think they're a zombie or do you think they're thriving or like going to be thriving? Should we get
Okay.
into some names?
Yeah, let's do it.
Palantir.
Thriving, but no one knows what they do.
That was a softball for you because they're trading at like truly an insane level relative to revenue. How about Big Commerce?
Oh, man. I really like their CFO. Their CAC payback period is very high compared to norms, but I think there's still a play here with agentic commerce, especially for B2B. So I think they're alive.
Well, they're trading at, I think, 1x revenue. So the only place to go is up from here. All right, PagerDuty.
I think that is like one of the more undervalued stocks. And this is not an investment show. Please do not take this as an investment advice. They have such a strong recurring revenue base, and it's an infrastructure cybersecurity type play that doesn't really go away. So I know that Claude scared some people with like the DevSec stuff and checking code, but I think like the alert systems, those have to be there.
And it's on-call incident management, like with this idea of, I think they charge per user. It's humans responding to incidents. If AI agents can do that incident response, maybe better than humans and in real time, doesn't that kind of kill a lot of their like literally PagerDuty business?
It could potentially. Yeah, it definitely could. I guess it's where the human is in the loop and how they want to be served. You have to meet the customer where they want to be served.
All right, let's go to some other ones. Let's go to the productivity space. Asana.
Did you literally only go through the CFOs that I've interviewed on my podcast?
I want to make this extra uncomfortable for you.
You're like picking out everyone I've sat next to at a dinner in the last year.
To be fair, I think on this public company list, you probably interviewed at least half of them.
They're cooked. I mean, what's interesting is people keep showing like, oh, I rebuilt Monday.com. I rebuilt Notion. I rebuilt Asana. But then are you really going to share that with other people on your team? And are they going to want to use it within their workflows? I don't know. So you can recreate it. Will people use it? I don't know. TBD. But I would say Asana is one of the more pure play SaaS companies that probably hasn't come out with as many AI features as like, say, a Notion.
To me, like this idea of project management and automated project management, it's still needed. But I have to imagine there's like an AI native approach to that where like it's work that is like orchestrated by AI. And that's a very different probably product architecture than what they have right now. So they have the mind share, they have the brand, but do they have the AI first product?
The only saving grace for some of these project management tools, Kyle, is people use them for use cases that like me and you can't even think of right now. So ClickUp, give you an example there. Someone on my podcast last week said, oh, we use ClickUp for procurement. ClickUp is not a procurement tool. I've also had other finance people in my CFO Tech Guide survey say that they use, I think Asana was like top 10 on the list last year. That is not a procurement tool, but it's incredibly flexible. So that's both like the benefit, but also the drawback of some of these. So the use cases and how we can't name them all, that could be the saving grace.
All right, I want to give you a couple more here. DocuSign.
I think that is alive and well because people use it as a document repository. So there was this funny meme that came out, or sorry, it was a tweet where this kid basically recreated DocuSign within the Note app. So he just made it so like within the Apple Notes, you could do a signature really quick. And DocuSign had to come out and be like, this is not a secure way. This does not count like as a signature, blah, 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 blah. I use DocuSign because I'm not really great with putting my files away. So I think that's trading at like below 3x revenue right now, which is pretty bonkers. I think it's closer to 2.
I'm torn on that one. Like I get the need for security and compliance, but to me, the value prop needs to move away from like the signatures and like, you know, contracts as like a system of record and needs to move towards like pulling insights from the contracts and being able to like have smart actions based on that data. Cause I think the data asset's really strong if you could do something with it. And I think other people will try to commoditize the data like repository component to go after that bigger, you know, orchestration component.
Yeah, the signing portion, that is not hard to create. But to your point, you're not signing something because it's not important. By definition, you're signing like stuff that matters. And if you can pull insights from that, that's a strategic high ground.
All right. Salesforce.
Only CFO I haven't interviewed, dead in the water, cooked.
Despite Agentforce.
Yeah, I mean, Matthew McConaughey hasn't done a great job at telling me what that does.
Nor has Mr. Beast. One more. Let's go with Datadog.
Oh man, their stock got hit last week, didn't it?
Like cannot even keep
Okay,
track.
so late Friday, we're having a pizza party with our friends, and all the kids are there. Maybe I walked over to get a beer or went to the bathroom, scrolling through Twitter, and Claude dropped an update saying that they can now do a bunch of security stuff that wasn't available before. And so like Palo Alto, Datadog, CrowdStrike, all their stocks were down between 5 and 10%. So I think they're still alive because like observability is a hard thing to build. If you're an SMB and you're thinking about buying Datadog, probably just get some sort of, now I'm back to the PagerDuty example, some alert.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
If you run go-to-market, you already know the problem. Your go-to-market data is everywhere. Ads, CRMs, sales calls, marketing, spreadsheets, but you're still guessing what to do next. HockeyStack is the AI platform for modern go-to-market teams that collects all your customer data and unifies it into a single system of action. Then you deploy AI agents that prospect the right accounts, help reps close and upsell deals, improve forecast accuracy, and automate what's already working across sales and marketing. Instead of running 5-year-old processes manually, your go-to-market team finally has agents that understand your ICP, your funnel, and your buying motion, and they execute on it. That's why teams like RingCentral, Outreach, ActiveCampaign, and even Fortune 100 companies rely on HockeyStack to cut through the noise, eliminate wasted spend, and make better go-to-market decisions faster. That's HockeyStack, the AI platform that helps go-to-market teams make space to think and win. Here's a growth tax nobody talks about. Every new monetization model you ship creates a nightmare for your finance team. Add usage-based pricing? Now you're tracking consumption against commitments. Launch product bundles? That's multiple performance obligations per contract. Offer mid-cycle upgrades? Woo! Good luck reallocating revenue manually. But that's exactly where RightRev shines. RightRev is the revenue recognition engine built for companies that can't afford to let accounting slow down growth. When your RevRec is automated, your product team can ship new pricing without asking finance for permission. And your sales team can close creative deals without worrying about downstream chaos. To get up on my CFO soapbox for a sec, I love talking about creative pricing models, hybrid pricing, credits, tiered usage. But I've seen too many companies where the sales team is celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. In a world where your pricing model might change 3 times next year, that flexibility is everything. If you want to scale your monetization without breaking your books, visit RightRev.com. That's RightRev.com, where modern monetization meets bulletproof accounting.
Here's a question. When was the last time you really had time to focus on growth and not chasing contract renewals, tracking shadow IT spend, or explaining rising software costs to the board? Yikes! The truth is, traditional spend management is broken. If you're still piecing together data from 5 different systems just to figure out what you're actually spending, while vendors keep on pushing those auto renewals and price hikes, my friend, I got a solution for you. That's where Tropic comes in. Tropic is an intelligent spend management solution that consolidates your spend data and processes into one unified offering, enabling insights and decisive action. It doesn't just show you where the problems are, it helps you solve them. From spotting hidden optimization opportunities like duplicative spend, to automating those painful procurement workflows, to giving you the best market data that turns every vendor negotiation in your favor. Tropic combines smart insights with real human expertise to keep you ahead of the curve. And I can say firsthand because I've used them for over 2 years. Their SaaS platform helps me with price checks. It helps me keep my calendar organized of when renewals are coming up and I can actually visualize it. And let me say, it saves me more than 10 hours a week on vendor management, and we've saved a ton on renewals. I'm walking into the boardroom with a lot more confidence. Isn't it time to turn your spend management into your competitive advantage? Visit tropicapp.io/mostlymetrics. That's tropicapp.io/mostlymetrics.
I'm curious about like this stock market sentiment in general. It feels almost like every other week you hear about some sort of SaaS company sell-off, not really because of the performance of companies, but more because people see Claude released a new update, OpenAI has a new product. Like there's something out there that investors are panicked is going to kill SaaS. So maybe like let's get into what's happening in the market first, and then we could talk about, is the market being rational?
Okay, so this is the first time in the last 10 years that forward revenue multiples now have a 3 handle on it, which means that the market is looking at tech stocks and saying we're willing to pay on the median 3 to 3.5 times the cumulative value of the next 3 years of revenue. Historically, this has been closer to 6x, and anything that's looked at as a premium multiple is around 10x. The ultra premium companies are somewhere around 20x, and then you just have some companies that make absolutely no sense, like a Palantir that's trading on some days at 50x, some days 100x. But like I said, there's been a sell-off. It brings a lot of these companies in line with non-tech companies. So traditionally, you would value a company based on its price to earnings ratio, but we use EV to NTM revenue multiples because SaaS companies aren't always profitable. So we need like a measuring stick that's consistent between them. So the multiples are down across the board, whether you're a good company or an average company, but they are extremely down if you are just mediocre or average. And so DocuSign is trading at, I think, like 2.5 times forward revenue. PagerDuty is trading at just over 1x. 8x8 is trading at 0.5x. So these are zones that we've never seen before. So either the world seems to be falling apart or some of these are drastically undervalued based on the recurring revenue that they have.
I spent 10 years in VC, right, before going full-time on Growth Unhinged. And I remember when I started in VC, the rule of thumb was SaaS companies are worth about 5x next 12-month revenue. And then during COVID, there was such a boom. And I think in general, just about every company got up to like 10, 15x next 12-month revenue. And you started to see the way that trickled down is if you were investing at Series A, Series B, you maybe be investing at 100x revenue, with the idea being like, let's get in now. The revenue is going to explode, right? Compound again and again and again, and they'll grow into this valuation really quickly. So there's the public comps out there, and then that influences a lot of private software valuations. But for valuations to go from that 10 to 15x where they were, say, in 2021 to 3x next 12-month revenue is pretty wild. So you had mentioned a good point about software companies are starting to trade more like regular Main Street companies. What's a typical like price to earnings ratio if you were to look at like stock price versus EBITDA? What are the typical multiples outside of tech?
Yeah, and so I usually look at EBITDA multiples rather than price to earnings just because like I don't trade stocks, but like I do know the private equity world pretty well. And so if you can buy a company 8 to 12x and it's a software company, that's pretty good. Service-based companies usually trade at maybe 4 to 6. So it depends on macro conditions at the time. But what's different about this one, Kyle, is it doesn't seem like any of this is macro driven. This is just confidence in an underlying business model. So when everything went up in flames and then boomed with COVID, those were due to what was happening in the outside world as it pertained to interest rates, as it pertained to businesses being able to do deals. We're not actually seeing a strong degradation in retention rates, renewal rates, or performance. In fact, some of these companies like ServiceNow are having some of their best quarters ever and are retaining customers really well, but the stocks are still down.
Software companies are now being traded more on the basis of price versus EBITDA as opposed to price to revenue. And the price versus EBITDA is, it's 12x, so above like what other businesses are trading at, but essentially not giving software businesses that much credit for the retention or ability to expand customers, and kind of assuming they look maybe more like high quality assets outside of tech. But let's get into like the underlying companies themselves. So obviously part of what companies were valued at historically was based on growth rates. So faster growing companies would be valued at a premium versus slower growing companies. If the underlying companies start growing slower, there's going to be a dip to valuation. How has growth rates kind of played into this?
So this all factors into what you call a discounted cash flow model or a DCF model. And what you're doing is you're forecasting out the growth of the company over usually a 10-year period. And then you end up in the terminal value, which is just this lump sum amount at the end that represents all the out years after that. And so what factors in is the growth rate of the company to make up the revenue, which flows down through the P&L, which gets you to that EBITDA line. And then you also have a discount rate because remember, money today is better than money tomorrow. So you have to take the interest rate of what you can assume is a risk-free rate and what it would cost you to finance this and bring it back to net present values. The interest rates haven't really changed in these models, but if I'm looking at it, what people are discounting now is the terminal value more so, because the revenue rates haven't changed that much either.
In 2020, was it 2023? It was the first wave of the SaaS slowdown, sell off, whatever you want to call it. And that was really interest rate driven. Interest rates were starting to balloon. We had been used to these really low ZIRP level interest rates, and that caused, big sell off and a decrease in multiples. What we're seeing now is interest rates haven't really changed from that period. If anything, they've started going down a little bit. Yeah, so we can rule that out. And growth rates are, interesting point that you brought up, that growth rates, we can kind of rule that out too. And so this is really just less confidence in the future trajectory for SaaS companies, independent of how they're doing today.
And Jam and Ball had a good quote. He said, confidence in the SaaS business model has shattered. SaaS businesses were long thought of as cash flow annuities. Lose money early on, flip profitable, and then every year print cash predictably. You could then calculate the intrinsic value of SaaS businesses by summing the present value of every annual cash flow with the terminal value assumption.
Where has this confidence level, where has it dropped the most? When you've looked at companies over the last year, which companies have had the biggest sell-off relative to the peak?
So I pulled a couple of stocks that have got hit the hardest. So Salesforce is down. They're down bad. I think they're down 45% in the last 12 months. So at one point, they're trading at over $300 a share. On Friday, they were trading at under 190. So they're down big. Oracle is down too. This is a mixed story though, Kyle, because they're also using up all their free cash flow to fund data center build-outs. But they were also around $350 a share. Now they're down at $150 a share. These charts are really ugly to watch. Figma, they IPO'd at 120 a share. Guess what they're at, Kyle?
Is that pre or post the IPO pop?
They ended that day at call it 120, I believe.
Maybe 60?
They're at $26 a share.
So they're down, 80% from the peak?
Yeah, 80% from the peak. Asana, they're trading at $7 a share. At one point, they were close to 25. These stocks have been hit really hard. They've never traded at levels like this.
There seems to be this sort of widespread movement across the industry with companies like Figma being hit particularly hard. What are some of the characteristics that you've noticed in the companies that are hit hardest versus the ones that have maybe been more resilient?
A lot of them are at the prosumer SMB application layer. I'll put it that way. That includes the likes of an Asana, a Monday, companies like that.
So you're saying product-led growth, PLG companies.
I was trying to say that without saying it. Yeah, I didn't want to offend you on the podcast, but basically product-led growth companies I think are being hit really hard right now.
Is the idea there vibe coding? So the less sticky, less enterprisey what you're selling, the easier it is for someone to just vibe code it in a weekend?
Yeah, things that aren't a core system of record or aren't integral to how a specific industry completes a job to be done, and things that you can spin up over a weekend, like you said, things that people believe they can vibe code.
I think the other thing for me, just saying it, is companies that have been reliant on the per seat pricing model. I don't know how much of this is investors factoring in pricing models, but generally for a lot of these companies, their revenue is directly correlated to the number of seats on the platform. And so anything that is going to mean seats sort of stabilize or start dropping means they're going to be impacted really quickly from a revenue perspective.
Well, if you think that AI is going to make fill in the blanks companies 15% more efficient, you need 15% less Salesforce licenses. And if that's sold on a per seat basis, I know on prior episodes, we've gone through the 17 different pricing models they've done in the last 6 months. So I don't know which one they're on right now, but any company that's seat based, you have to think that if you're reliant on hiring to continue, efficiency is actually not in your favor. You want more people at these companies.
Your thesis is, and not to put words in your mouth, but your thesis is that, there might be some logic here from the investor community, but really to me, indiscriminate and lazy kind of across SaaS companies. So maybe what do you really think about this move?
And I'm coming at this from the perspective of an operator, a person who's used a lot of these tools, a person who has helped figure out how we spend our money on people and software. I'm not coming at this from let me try to find arbitrage and make a couple bucks in the stock market. So I got to get that out of the way at first. But I think this bear case that people are pricing in, Kyle, forces you to believe three things. I'm going to take you through them, okay? So the first thing is that retention rates will blow up, and they haven't materially moved in the last 12 to 18 months. They are definitely down from 2021. I'm not arguing that. Back then you could print NDRs above 140% because the headcounts are skyrocketing. But to use ServiceNow as an example, their renewal actually went up a point to 98% in the past quarter. Now, growth rates are down a bit, right? They're not like horrific or anything, but a lot of that growth was linked to those sky high NDRs. They move in tandem. But most SaaS companies have stronger rules of 40 now than they did 2 years ago. And they're not losing 150% of revenue. They're just getting there using more profit points than revenue points, which to me is kind of funny, right? Like as a person who's been in charge of helping to run these companies in the scoreboard you're measured against, that was always the argument against SaaS. Like, oh, you're not profitable, that it produced no profits. So in that sense, you're kind of damned if you do, damned if you don't.
You're saying that retention isn't down that much. Are you referring to net dollar retention, which is after expansion, or are you referring to more of a gross retention, like renewals and logo retention?
I'm referring to both. And logo retention in particular, from my vantage point, the benchmarks that I'm seeing is pretty solid at many of these companies. Now, there are a lot of companies out there who, there are always companies that are bleeding customers. NDR is down because you can't expand the customer as much, but it doesn't mean you're binary just losing customers. Everybody's just losing customers overnight. There are a lot of companies that are still using software even if they're not expanding it.
Okay, so you're thinking point one, there's no real evidence of vibe coding as a replacement for software. If anything, people are keeping their products. Maybe they're not expanding seats or buying, the more expensive license, but they're keeping their software products, software investments. So this is pretty durable revenue. What's the second piece?
The second one is that AI will be delivered through something other than SaaS, but it's not. If you look at it, Anthropic sells a subscription. OpenAI sells a subscription. AI native ERPs, SaaS. AI native billing, still SaaS. AI native CRMs, SaaS. And also every vertical AI startup that I'm seeing, maybe priced differently than seat-based SaaS, it's still some form of software delivered through the cloud. So maybe how you price it changes, Kyle, and you're the expert in that. A lot of companies have moved to hybrid pricing that combines subscription and usage, but I just think that's a natural evolution. But to believe it all goes to zero because AI means you're also betting against the primary distribution mechanism for AI. It's a picture of the snake eating its own tail, Kyle.
To me, when I look at AI companies, they're increasingly investing in software, right? So they're trying to differentiate from not just being an AI wrapper. And so that means having better integrations with other companies, having better data foundations, having better, more collaborative workflows. Like a lot of it is sort of building more software infrastructure around the AI capability. And so you're starting to see this kind of blurring of the lines between what's an AI company and what's a SaaS company. It's like they kind of look the same, or they're increasingly the same.
Are you separating companies now in your head, though, between AI companies and SaaS companies? Is that a thing now? Maybe I am too, and I didn't realize it until now.
I don't have a term for classic AI companies. I've seen some people write AI AAS, but I cannot get myself to do that.
AIs.
How strong is the AI story around what they're doing? And you don't really need to be an AI first company to have a good AI story. Is there an AI story here? And then does the user experience around the product feel more like AI, which is more like a chat first infrastructure or chat first experience or an agent first experience? Or does it feel like a point and click SaaS experience? Those are the two delineators in my head, but really those aren't that strong.
SaaS is less an experience and more how it's delivered, right? I get that it may be everything's a prompt bar now, but it's still SaaS to me.
It'll always be SaaS to you, CJ.
Well, the third one, and I think this is a big one, it's that startups with no data will outcompete the incumbents who have all of it. So ServiceNow has every ticket your org has ever filed. It has every resolution, every escalation path. They know how your company gets broken and then fixes itself. Salesforce, for everybody ragging on it, I was ragging on it, but they know your entire customer history, who bought it, why, when, the reason for them churning and what brought them back. And then NetSuite, they have the receipts from sales kickoff, that ridiculous bar tab back in 2019. These are the systems of record that Like, are you just going to build an agent on top of it and they're going to say, okay, yeah, that's fine? I would think that these guys are pretty competent themselves, that they will also build some agents that will accrue some value. Now, I am a little bit scared. Like in 1 week, I've changed this part of the bear case a little bit because I was very surprised that Claude came out and dropped a PowerPoint plugin before Microsoft could, in like a game-changing way. That's a little scary. Like, knock, knock, wake up. Hello, where are you? I don't think these companies are just going to go out without getting value from the data.
This does in some ways remind me of, your old cable company. So like they used to make most of their money from like cable TV subscriptions, and then streaming started to take off, and everyone's like, the cable companies are dead. Actually, turns out they all sell internet too, and they're just going to raise the price of your internet service. There'll be some switching of budgets, but not necessarily less spend overall. And I think the data is a strong advantage because people need their data and they need it integrated in with their AI systems. And so even if you're not, let's say, going to use like Slack's built-in AI, you still want access to all of your conversation history from Slack, and you still want Slack as a workflow tool. And so it can be still quite valuable, but maybe a different store of value than what it had before.
Just because you can build something that looks like Slack overnight, their UI and UX, it looks a lot better than Microsoft Teams, but this is not the most complicated thing in the world, I bet, for smart developers to make. Doesn't mean that you can get someone to adopt it and then also to have the data on how it's been used in the past to make it useful. Technology is fundamentally the marriage of people and then how they use the technology. You can't just say, oh, I built this and now it's just as good. Like it needs to ingratiate itself into the org.
If you go back to the on-prem to SaaS transition, not that many on-prem software companies were really great at reinventing themselves as SaaS companies. I think Adobe's probably seen as doing a relatively decent job. I can't think of that many other great examples. And there's a reason why Salesforce is such a big company. I think with these SaaS and AI companies, there's an opportunity for SaaS companies to reinvent themselves. They have the customer base, they have the workflows, they have the data. But building in an AI first way might be cannibalistic of their core product and might require like a really strong reallocation of like team and spending in order to go after it. And so you'll see companies like Intercom that I think have really gone aggressive and out front in doing this. But it's really hard for every company, especially if you're a publicly traded company that has to hit quarterly earnings, to reinvent yourself and know that it's maybe best in the long run for your business, even if there's a short-term hit.
Can we talk about a couple other situations here that makes me think that software, it can't go to zero?
Let's talk about it.
So if we build our own software, and I'm not trying to be flippant here, who are we going to blame when it breaks or it does something wrong? It's the same reason we pay McKinsey to do consulting, and also the same reason we pay NetSuite to handle our financials in many ways. If you build it yourself, you're completely on the hook for this, the recommendations, the quality of the data, how it works. What's your thought on that?
You need a place for all of your data, right? But does that need to live in a bunch of SaaS companies, or should there just be a central repository, like a fancy database that you have that you can pipe into all of the different systems that need it through MCP or whatever it is? Do we need someone to blame when it breaks? I guess the inverse of that would just be to say, let's have a really centralized kind of core that is resilient, and then the connectors could break, but the underlying kind of foundation is still healthy.
I guess the reverse of that too is, yes, you could go out and build something that is like NetSuite that gets it right 98% of the time. But I'm willing to pay for the other 2% because in the finance world, if you're 2% wrong, you're like 100% off. You can't have that and have your business be a going concern to be trusted by customers and to be trusted by your board and everybody else.
There's so many competitors to every product. I even think about like how many software companies inside of a company are doing the same thing. Like how many people have Slack and Teams and Zoom chats and like Google Meet and like all of these ways of communicating internally. I think in this new world, you could say, hey, we're actually, the most important priorities for the business are AI for becoming an AI first company. It's probably fine if we consolidate our messaging stack to be just Teams or be just Slack, right? Like I think that there's there's so much duplication right now that there's room for savings and optimization without having this be a major issue about like something breaking. And in fact, if anything, having everyone on one system might be better all around.
Put the breaking to the side. Let's say it does all work, but SaaS sprawl is a huge problem today. And that's with production-ready apps. Imagine trying to stitch together this patchwork of software that's not even production-ready. Now we have Beth in accounts payable who spun up something that like John over here in, I don't know, a different department has to be able to use, and it breaks all the time. I get maybe we're not paying for all these things, but we're paying with people's time to build it, and they're not uniquely qualified to build it. Hopefully someday AI does get to the point where everyone can be a cracked engineer. Not that I figured out what that means yet, but you're going to end up with like 10 times even more SaaS apps, even if you're not putting $1 down to buy them.
Poor Beth in accounts payable. No, I do think that sprawl problem is a real issue. I mean, there's so much more appetite to build things at DIY right now, especially everyone has like a custom business process. I don't need to change my business process to adopt software. I could just build an AI solution that mimics my process. And like people are using these AI agents or AI tools in like personally as individuals and on behalf of their team. And a lot of them are not sanctioned by any sort of like internal IT team. And they're certainly not being managed by anyone that has like that much of a concern around like data privacy, compliance, all of these other things. And so organizationally, folks are setting themselves up for a mess to deal with in the future.
And you teed me up there with the information and security and privacy stuff. Kyle, have you ever tried to build an app before and get it approved just by the Apple App Store?
I have not tried that.
It's pretty hard, actually. You have to change a bunch of stuff. A lot of times they give you feedback, then you have to resubmit it. Imagine trying to get like JP Morgan to buy something from you, and then you're going through SOC 2 compliance, and they're like, is that certified over there? That little weird tool that Beth in accounting made, something like that. It throws off the compliance stature of your entire org when you start to just bring all these applications in that are handling the data of your customers.
That is the core challenge with vibe coding is, can vibe coding be done in a way that is reliable, secure, and enterprise ready?
Well, the collapse of SaaS might be a business blunder in and of itself, but let's get in on some specific business blunders, guys. Why not?
Favorite business blunder this week was about Cluely, our favorite app for cheating. Did you see the interview of their CEO in Harper's?
Kyle, this is the best thing I've read in a while. Thank you for sending this to me.
So this author named Sam Chris wrote a piece called Child's Play, Tech's New Generation and the End of Thinking, interviewed Roy from Cluely, and he did not have the best experience during this interview.
When people say, oh, it's a hit piece, is this what a hit piece looks like?
He wants to interview Roy at Cluely, and he goes, hey, I'd love to use your own product while I'm interviewing you to see if I can ask you better questions. And of course, Roy, being good tech founder, is like, yeah, use my product. Like, want more people adopting it. See, I want to show this off. The author then booted up Cluely, and it immediately failed to work. Roy then stormed downstairs to the product floor and yelled about Cluely's not working. There was 15 minutes of panic tinkering as the team of elite coders tried to get the product back online. So then 15 minutes later, they returned to their places, whereupon Cluely immediately went down again.
The description of them trying to describe who's going to use their products and saying, like, this layout isn't good for old people. But they said, apparently a 35-year-old wouldn't be expected to know how to use anything more advanced than a rotary phone. Are we that old now? Am I 35 old? Am I?
I'm 37, so I'm ancient.
Another employee scrutinized the proposed layout. I think it's bad, he said, but it's low-key not worse. What we have is anyway really bad, so anything is better. This part's hilarious. Through all this, Rory scrolled through X on his phone, simultaneously baby-faced and creatine swollen. He was wearing gym clothes with 2 curtains of black hair swung over his forehead. Finally, he looked up. So number 1, he said, we're killing the chat bar on the left. There was no number 2. Meeting over.
Inside the operating of an AI company.
I'm going to start doing that no matter what I say. I'm going to say number 1, even if I don't have a number 2 or 3.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Additional production by Steve Sarasoli. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. mostly. If you like this podcast, hit subscribe and give it 5 stars. It'd only take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day.